Welcome to Buy, Hold, Sell. I'm Sam Willis from BTIG. We've got Carl Siegling from Cadence, and we've got Roger Montgomery from the Montgomery Fund.
G'day.
We're talking banks. There's a lot of news out there on the banks lately. There's a number of factors impacting them. To bring some of those factors to light, Carl, can you fill us in on the various factors out there that are impacting the banks?
Look, I think the banks, there was a time when they were trading by, and that was straight after the global financial crisis when no one wanted to touch them. They were, probably in hindsight, an exceptional buy at that stage from a trading point of view. We're now talking about a group of assets that are trading at 200 to 220% of their underlying NTA. They are growing at between 2 and 5%, and they're trading on somewhere between 13 to 15 times PE. That is not an attractive sector or group of stocks for us to be putting our clients' money in. So we would have a sell on all of them. And you'd notice in our portfolios that we've migrated out of 2/3 of the position. We've got 1/3 to go in 2 of the 4 banks, and that'll be the end of the banks in our portfolio.
Right, okay. Not good for the banks there. Roger.
What's interesting is that they're trading today, I think, based on optimism around their loan book growth rates. So APRA came in, put a cap on a couple of things, a cap on the amount of money that can be classed as or lent to interest-only class loans as a proportion of total loans written. And there was also a cap on investment loan growth. Now what's actually happened is the banks had to take a guess at how much increasing interest rates and putting restrictions on lending would affect both of those things. What it's done is had a significant negative effect on the growth of investor loans and also on the proportion of loans written that are interest only. In fact, interest only loans written today are now about 15% and as a proportion of all loans written, and APRA's cap is 30%. So there's now a catch up. The banks are catching up, and the way they're doing that is obviously lowering interest rates, and that's hitting all the headlines. So the market, I think, is actually taking a good look at what's going on, projecting it out too far, and saying, you know, this rapid recovery will continue. But of course, there are caps there. And you've got an enormous tidal wave of interest-only loans that were written in 2015, 2016 that were way above the caps. And what will be interesting will be what proportion of those loans that were interest-only will be able to be refinanced as interest-only loans. Now, that will come down to a negotiation between the banks and APRA about the definition of what a new loan is. Because if a refi is not a new loan, then it's all fine, and we have nothing to worry about. But if a refi is actually a new loan, then there's big problems because people will be forced onto principal and interest. If they're forced onto principal and interest, their payments go through the roof, and that's potentially an Armageddon scenario. Now, I actually think that the banks are ridiculously overweight or overrepresented in our index. You know, the 4 banks are 27% of the ASX 200 and financials are 37%. Nowhere else in the world do you see an index that has that kind of weighting. So we don't think that's pragmatic, and so we're significantly underweight the banks. You know, we have about a 5% weight to the banks. So we're not sellers, but we're underweight, significantly underweight, which is effectively saying the same thing.
Would you have a preference of the 4 if you had to own one?
Look, if we wanted to own one, we would want a bank that is 2 things. We'd want to be owning a bank that doesn't have high exposure to high loan-to-value ratio loans. So we would probably be happier owning Westpac, for example. But we also think this commentary that's going on in the market at the moment that there's a problem in mortgages and therefore you want to be invested in small business lending, that's folly because small business owners are the ones who have the mortgages on properties.
A key thing to note here is that whilst the banks have been relaxed and not after the home loan for the new home buyer, is the new entrance into the sector. So
yeah, look, I think Roger touched on this. You know, these APRA is being much more, shall we say, diligent with the banks on what they can and can't do. And what does that do? That just squeezes the banks out of that part of the business and creates a whole lot of new entrants who are just having a field day lending money at the moment.
And a couple of those names?
Oh, Money3, Access Today. home loans, HOM.
Yes.
They've just announced a whole lot of new funding, and they've backed an old book in runoff into that business, and they're going to be manufacturing new product and distributing. So as one man's meat is another man, one man's poison is another man's meat. It's that way around. As the banks don't participate in that space, so the new entrants participate in that space. As the banks don't lend to small and medium-sized business, as they don't lend to what they call these dirty, non-conforming people, they're non-conforming loans, so someone else gets them. And by the way,
they're all
these
Bill
dirty,
Shorten voters,
yeah,
by
these,
the way.
but the dirty, non-conforming people, the dirty ones. I'm a small businessman.
Yeah,
I
correct.
don't get a wage from the government, so I don't have a pay slip every month. So I am one of those non-conforming loans. It's amazing when you start looking around how many people actually don't conform with what a supposed conforming loan is. So it creates a whole lot of really great new opportunity for these players.
So preferred name in the
Oh, look, of those three, I think I was just amazed at the home loans result. 25 to 30% EPS growth trading on 9 times earnings. We always say we can't find value out there, and there it is. All Money 3 starting to lend, really, really strong earnings growth on a very, very conservative multiple. There are going to be a lot of opportunities where the bank stops lending. That doesn't, just because the bank stops lending money to SMEs and to people that are non-conforming in Australia, doesn't mean they don't continue to run businesses and run the economy and drive cash flow. They have to have money. They have to be lent to.
Okay, home for Carl, one to look at. And Roger, do you have a disruptor in the sector?
My issue with some of the smaller companies that are emerging is that they're at a higher risk of being disrupted themselves by well-funded private equity-backed startups. And one of the businesses, for example, in the mortgage broking industry is a company called Lendy, which owns Click Loans. It's funded by private equity and high net worth individuals. It's digitising and automating the mortgage broking process without stores. So the opportunity for those types of businesses to disrupt some of the smaller ones just keeps us away from that space.
Right, okay. So again, you'd be underweight the financial sector, is
Absolutely.
it fair to say?
Yep.
Okay. There you have it. Tough to be in the banks, tough to be in the financial sector. For Carl?
Opportunity. There will be some opportunity.
Look,
I mean, there's always opportunity.
Always.
Yeah.
Okay. There you have it. Thanks for coming, Carl. Thanks
you.
for coming, Roger.
Pleasure to be with you.